All right. Good morning, all you magnificent melon heads out there. Today's Thursday, November 16th, 2023. Happy birthday, Gigi. And, well, what did we get Gigi for her birthday today? We got her Walmart earnings and continuing jobless claims, both on the rise. We got continuing jobless claims continuing to rise this morning, up 32,000 to 1.865 million for last week. That is up from 1833 or 1.833 million last week. That is 8 consecutive weeks of increases in continuing jobless claims. Now, continuing jobless claims, that means you lost your job probably about a month or two ago, because typically there's a little bit of severance. You have to apply for unemployment. By the time you start collecting jobless benefits, then you go on the initial claims. And when you've been collecting for more than 1 week, then you go on continuing claims. So this is the delayed reaction to people who lost their job several weeks ago. 8 consecutive weeks of continuing jobless claims rising. And also along with that, we got a big jump in initial jobless claims this week. That jumped up 13,000 to 231,000. That's up from 218 last week. So as people lose their jobs, they're having a harder time finding work. And now we're getting a big jump in people losing their jobs, 13,000. It's a big jump relative to this year. Historically, it's not a massive jump. But it does show the trend of, to quote Jerome Powell, reduced tightness in the labor market. In other words, people are losing their jobs or people are having trouble finding work, and that's putting downward pressure on wages. Congratulations, Federal Reserve. You've hurt us enough with the inflation, and now you're hurting people by killing their job prospects. You must be so proud of your monetary policy. Meanwhile, have you seen the stock market? Up, up, up. It just keeps going up and up. The wealth disparity in this country continues to expand. So what's going on? This is the lagging effect of the Fed's tightening cycle. People are starting to lose their job. Companies are going out of business. And again, it takes a while for these things to reach into these government numbers. We saw a lot of layoffs, a lot of stories about big tech layoffs in January. It took several months for those layoffs to show up in the unemployment numbers and the jobless claims numbers. And it looks like whatever we're seeing right now is people who lost their job in the middle of the summer. Now they're starting to show up on the government unemployment rolls. Now, the other thing is we're seeing an increase in these anecdotes about people losing their jobs, about companies planning layoffs. That's starting to pick up. So this trend of increases in unemployment, increases in initial and continuing jobless claims, that's going to continue for the foreseeable future. That is that lag effect. This is from tightening interest rate rises that happened months ago, finally starting to show up. Pay attention, all you housing bulls, by the way. The missing ingredient to a housing crash is unemployment, because when people lose their jobs, they become home sellers whether they want to or not. Also today, we got Walmart earnings. Walmart earnings were actually pretty good. Same-store sales up 4.9%. That is the exact same 4.9% that Target sales were down for their same-store sales numbers. So Walmart is just yanking that market share right away from Target, who made a couple of unforced errors earlier this year. And along with Walmart's successful pivot to grocery that Target has failed to match, you've got Walmart is pretty much eating their lunch. Now, yesterday, Target stock just rocketed higher yesterday on the news that, well, I don't really know what the news was. I guess that things aren't getting bad as fast over at Target. The stock rallied a little bit. I guess people were expecting worse news. Now, Walmart actually came in with pretty good numbers, but their forecast came in low. They guided a little bit lower than the market was hoping for, and so Walmart shares are under pressure right now. And as always, big retailer warning about weak demand, about softness in consumer spending, and also cutting inventory. Walmart's inventory down 4.8% in the last quarter. Watch out, guys. Those fourth quarter GDP numbers, they are not looking good at the moment. With that, let's shrink my big melon of a head, see what's going on in the markets. While we're doing that, guys, don't forget that like button. It really helps get the word out about this channel. And, of course, if you're new here, hit that subscribe button. We do this every morning. Have your coffee with the melon heads. Looking at the S&P 500 this morning, it is 0.0 points at this point, basically flat. Oh, there we go. There's a little bit of green. So basically the S&P is unchanged at the moment. It was down earlier today. The Dow is still looking to open a little bit lower, about 65 points to the downside, or 0.2% lower ahead of the opening bell for the Dow. And the NASDAQ is down by 15 points, or 0.1% lower ahead of the open. So stocks are pretty much flat with an emphasis to the downside, but not a lot of reaction at the moment. Looking over at the commodities board, gold is having another good day. December gold futures trading at $1,975. That's up $11 or half of 1%. December silver futures at $23.95, looking to take back that 24 handle. Didn't we have a 21 handle not too long ago? Up 41 cents this morning, 1.76. Congratulations to the silver stackers out there. We've got platinum and palladium are both pretty much flat for the day. And West Texas Intermediate December futures for crude oil trading at $75.69. That's down another dollar or 1.27%. So oil under pressure here. My guess, not liking those jobless claims this morning. Looking on the DXY, we have got a 104.16 reading on the Dixie. That's down about 23 basis points. Dollar really weakened on that jobs report, or the jobless claims report that came out a few minutes ago. Looks like the market liked that weaker jobs report. Weaker job market means more dovish Fed, less aggression from the Fed, means a weaker dollar versus its peers. So the market is reacting to that this morning. And looking over at the bond market, we have got lower yields again. It looks like the middle of the yield curve is taking the most pressure. At the moment, the 30-year is down 5.5 basis points, yielding 4.638. Remember, guys, yields heading lower. That's bond prices heading higher. So people are buying bonds this morning. The 10-year yield at 4.463. That's down another 7.5 basis points, giving back much of the gains from yesterday. The 2-year, 4.827%. That's up almost 9 basis points. And the 1 month yielding 5.388. Looking at reverse repo, guys, we got another low in the reverse repo yesterday. This is an important one. This is your liquidity crisis in the making. Let's expand this a little bit so you can see it. Yesterday, reverse repo dropped by another $44 billion. That's down something like $75 billion in 3 days here to $944 billion. My red trend line here shows reverse repo going to zero by February. It remains intact. All else being equal, nothing else changes at our current rate. This thing will be out by February. Maybe something changes, maybe not. But right now, this trend is intact, guys. We're just hugging this red line down as we go. I'm not touching this thing. I'm not going to move it. We'll just see where it goes from here. Looking over at the continuing jobless claims, this is the big story this morning. Continuing claims in the United States increased to 1.865 million in the week ending November 4th of 2023. That's up from 1.833 million in the previous week. Continuing claims in the U.S. have averaged 2.767 million from 1967 to 2023. So, guys, that's important. That historical average, we're still well below the historical average of continuing jobless claims. So this is still, relatively speaking, a tight labor market, at least by that metric. But the important thing is not the absolute number here. The important thing is the trend. And look at this trend. This is going back up to about the beginning of August. You can see here pretty much since the second week of September, 8 consecutive weeks higher here. 1, 2, 3, 4, 5, 6, 7, 8. Currently to 1.865 million. And again, this is continuing claims. So this is people building up on the unemployment rolls. As people lose jobs, a lot of them are not able to find work right away, and they're staying on the unemployment rolls for longer. So I would also add, guys, that when this happens, this is the tax basis of the country shrinking, and this is the demand for government services increasing. Jobless benefits is a government service. So as this number gets worse, government deficits are going to get bigger, which means more supply dumped on the bond market, courtesy of Janet Yellen, which means that reverse repo draining down faster. So there is something of a negative feedback loop involved here with government spending and higher interest rates directly proportional to jobless claims on the rise. Also, initial jobless claims in the week ending November 11th, the advanced figure for seasonally adjusted initial claims was 231,000. That's an increase of 13,000 from the previous week's revised level. The previous week's level was revised up by 1,000 to 218. So this is initial claims, people who first go on the unemployment rolls. Big jump up. We got the highest one going back to August here. Again, a trend since the beginning of September. You guys notice, okay, there was a little blip down here, but I'm seeing an increasing trend since the middle of September. The situation in the job market is getting worse. And another thing I would just point out on the continuing payrolls trend, looking at this chart again here, we had a big increase in continuing jobless claims early in the year. That was all those big tech layoffs that we saw, right? That was on the rise pretty much all through the spring. It stopped after the bank term funding program, after the Fed started injecting liquidity and interest rates came down. We saw that the initial jobless claims started to come down. I'm sorry, the continuing jobless claims started to come down. Then we had that big monster bear market in the bond market last week or last month. Look, continuing claims starting to pile up again. So, this does somewhat mirror the trend of the interest rates on the long end of the yield curve, guys. What the Fed does and what the Treasury does absolutely has a direct impact on your job situation, even if you think it doesn't affect you. And the other thing I would add, guys, is the trend. Look at the steepness of this rise in continuing benefits here. It is much steeper than we saw earlier this year with all those big tech layoffs. And this is going to accelerate. Remember that big jump in initial claims and the increasing anecdotes about layoffs from banks and from other institutions. So going to have more people joining the ranks of the unemployed. Let's talk about Walmart stock here. Walmart stock falls after soft guidance, offsets, and earnings beat. Walmart's Q3 numbers were better than expected, but EPS guidance was below consensus. Walmart stock fell by 6% early Thursday after the company offered guidance from 2023 that was below consensus, offsetting a profit and sales beat for the third quarter. So Target gets rewarded for a terrible quarter and Walmart gets punished. This is your upside down world. Some of the important things here. Walmart's U.S. same-store sales rose 4.9%, while e-commerce rose 24%. Average transactions were up 3.4%, while average ticket was up 1.5%. These numbers are all fantastic from Walmart here. And again, that 4.9% increase in same-store sales, I tell you, the Target executives have to be looking at that and grinding their molars this morning because Walmart has literally reached into Target's pocket and said, I will take that market share. Thank you very much. And Walmart is seeing the gains from that. Walmart not making the unforced errors that Target is making. Walmart has a much better grocery program. The groceries are getting people in the door. And while they're there, they're saying, okay, while I'm here, I guess I'll go buy other stuff. Target doesn't do that. When you go to Target, you have to get past their stupid dollar store ripoff, and then you have to march all the way to the back of the store before you can find the food past everything else. Walmart has done a better job of that. Something else important I said here. Now we're going to move on from that. Let's look at Walmart stock here. Currently down 6.25%, trading at 159.19. Again, that is all on that lowered guidance from last year. So Walmart is right now getting punished for lowering their guidance. Want to send a shout out to Frog Capital on Twitter. He's been putting out some pretty good stuff lately, and he came out with this stuff. He's saying this is nice. Walmart seeing increase in grocery sales, but strong pharmacy and immunization sales and losing sales on merchandise. Frog has done pretty well. Check out Frog at Frog News on Twitter, guys. I follow him, and he's been really good with the Target and Walmart earnings these last few weeks. Grocery, they're seeing benefits from inflation here is what they're saying. Pharmacy is doing really well for Walmart. Again, that's something that's helping get people in the door and get them to spend money on other things. Also noted here, general merchandise, seeing the lowest growth in general merchandise. They're saying general merchandise sales reflected softness in discretionary categories, including apparel, home, and toys, but automotive categories continued to perform well. So there's a couple of things in there. People don't have money to spend on discretionary items because they're broke. And you've also got the fact that because nobody can afford a new car because of interest rates and because of the price of new cars, that automotive categories at Walmart are doing well. More people are buying batteries for their old clunkers, changing their own oil. I don't know, but they're buying more automotive-related things at Walmart. I think that reflects an increase in the age of the average car on the road in the U.S. And also from Frog today, I said something similar to this on my live stream yesterday. I didn't have the numbers to articulate it well, but Frog is all over this. Good stuff here, Frog. Quoting the Bureau of Economic Analysis, remember those last quarter GDP numbers? The increase in real GDP reflected increases in consumer spending and private inventory investment. Those were the two big categories that drove that 4.9%. There's that number, that 4.9% GDP growth from last quarter. It was consumer spending and private inventory investment. But then let's go look at the biggest retailers in the country and what are they doing? Home Depot sales were down 3.5%. Their inventory was cut by 11%. Where's the increases in consumer spending? Where's the inventory investment? Target sales down 4.9%, cut inventory by 14%. Again, inventory and sales down. Walmart sales were up 4.9%, so there's some of that consumer spending, but Walmart also cut their inventory by 5%. Inventories going down, that is negative GDP growth because when inventories expand, GDP counts that as business investment. And so it looks like GDP growth. Well, where did that inventory come from? It didn't come from Home Depot, Target, or Walmart. And if you take out those three, those are three of the biggest names in the country when it comes to retail and consumer spending. Where did that inventory growth come from? E-commerce, maybe? Well, Amazon, I'm grasping at straws here, but this doesn't really add up, as Frog Capital is pointing out. And something else I would mention, guys, this one is a couple of days old, but considering what we've seen in Target and Walmart earnings these last few days, warnings on weak demand are piling up this earnings season. Earnings management calls are plagued with demand concerns, and profit warning news trend is at a high only halfway into the season. So whereas in prior quarters, it was all about who mentioned AI or who said soft landing the most, now people are saying weak demand. Does that sound soft landing-ish to you? We're seeing jobless claims rise. We're seeing consumer spending down. We're seeing inventory down. Does that sound like a soft landing to anybody outside of CNBC or the Federal Reserve? Reading down here, more companies are flagging concerns over the looming threat of an economic slowdown this earnings season, striking a cautious tone. At just over the halfway mark of the reporting period, this was 2 weeks ago, weak demand is among the top trending phrases on earnings calls, according to Bloomberg analysis of transcripts for the S&P 500 and the Stocks Europe 600. If the pace of mentions holds for the next few weeks, it would be the most on record, according to data compiled by Bloomberg going back to 2000. And this is demand worries. This chart is shown here. Demand worries plague U.S. European earnings. Weak demand is on course for a record number of mentions this season if the trend holds. I don't have an update on this data because the story is 2 weeks old, but based on what we just saw from Target and Walmart, I think this trend probably has held through the last 2 weeks. This is the number of mentions of weak demand on quarterly earnings calls for S&P 500 companies going all the way back to the first quarter of 2008. So this does include the GFC, and this does include the initial COVID panic. And look at this, guys, more mentions than any other quarter in history of weak demand on conference calls. Where is that strong and resilient consumer? Where is that soft landing? Sure as heck isn't in China. Check this one out. China housing woes worsen as prices fall the most in 8 years. Home buyers are deterred by an uncertain outlook, analysts say, and the property slump is deepening despite stimulus measures. Now, yesterday we talked all about how China's home sales are down on an annual basis by square footage, by the area of property that being sold. Wow, I really butchered that talking point. Yesterday, we talked about how annual sales were down 20.33%, and that's by floor space. That's an increase of, Jesus, I'm really butchering this one, guys. Last month, it was 19.77% lower. The month after that, lower by 20.33. So the sales by area are declining, and they are accelerating as they decline. In other words, the property slump is getting worse. Now, that's in terms of square footage, but let's also talk about prices, because prices are down by 0.38% in the last month. That's after being down 0.3% the month prior to that. So prices are declining faster and accelerating as they fall down. And I really got tripped up there because of the metric system. I meant to say per square foot, but China doesn't use the metric system, and I didn't come up with square meters right away, and I just butchered the whole segment from it. Moving on, shall we? China home prices fell the most in 8 years in October, signaling the property slump is worsening even after the government ramped up efforts to revive demand. New home prices in 70 cities, excluding state-subsidized housing, declined by 0.38% last month from September, when they dropped 0.3%. So they're dropping still, and they are dropping faster. That's according to the National Bureau of Statistics figures showing Thursday. The decrease was the steepest since February of 2015. And this is showing, the black line here is new home prices. Now, this is showing based on a rate of change from 2020 values. All right, so 100 here equals the price in 2020. Both charts begin there, and they show both new homes and secondhand homes. The prices were rising. That was right up until the three red lines policy in the middle of 2021, when they started falling. And then, in the beginning of this year, the China reopening story. Yeah, China's big comeback. That lasted about 3 months. And now the prices are falling again, and they are accelerating to the downside. Both new homes and existing homes, the prices are falling fast. Fewer homes selling for less. The developers are going bankrupt. And guys, if the homes are not selling, and if they're selling for less when they do sell, that means those bonds are going to get worse. That means China's banks are going to get worse. So things are not looking good in China. And I guess Jack Ma feels the same way, because Jack Ma's family trust is going to sell 10 million shares of China's Alibaba. I guess that's what he learned when they sent him for re-education a few months ago or last year. Jack Ma was getting too popular in China. Chinese billionaire Jack Ma's family trust is set to sell 10 million American depository shares of Alibaba. That's for about $871 million. He is cashing out big time, the e-commerce company said in regulatory filings. The sale will be done by November 21st by JSP Investment and JC Properties, funds that are part of the family trust. Alibaba and the Jack Ma Foundation, the philanthropic organization that handles media queries for the billionaire, did not immediately respond to requests for comment. So Jack Ma's getting out. He's cashing out at the top. He's joining Jamie Dimon from JP Morgan, who is also selling out for the first time. So executives dumping shares. That is a trend we're starting to see as well. And I want to say thank you very much to Mr. Dan Hedin. Says, a first watching nobody at 30,000 feet. Oh, Dan is in the air. Thank you, Dan, for watching it. Hi, Dan. Way up there. Full flight, I'm saying. And airport was busy at 6 a.m. A lot of families traveling for the holidays. Happy birthday, Gigi, and let's hit the like button. Well, thank you very much, Dan. Have a safe flight, sir, and thank you for the well wishes. And I guess that's a good sign for GDP if we're seeing healthy travel, because the airlines have been warning quite a lot lately that we're seeing fares were down. They were losing pricing power. They were pulling flights off the charts. So I guess that whatever trend is happening in travel, it is not hit whatever flight that Dan is on. Dan, safe travels, brother. Have a nice holiday weekend. And thanks again for the support of the channel. And thank you, Nashville Pasta Man. Says homes are coming onto the market in November. Tell me you are having financial problems without telling me you're having financial problems. I do think we're going to see an increase in homes, Nashville, both from people losing jobs, which is still at a very low rate. I just want to add, historically speaking, job losses are very low. Unemployment is still very low, but the trend is in the upward direction. It's the trend you need to pay attention to. So we'll see homes hitting the market for that. We're going to see homes hitting the market because investment properties are not cash flowing. The cost of ownership is much higher than the cost to rent right now. That means landlords are losing money, and a lot of wise landlords are going to cash out before the bottom falls out of the market. We're also going to see short-term rental bans start to result in new supply hitting the housing market. And also, we have got new home builders have a lot of supply coming onto the market. There is a lot of new multifamily construction in the U.S. right now, and there's a lot of single-family construction. See also that interview I did with my buddy Travis from Real Estate Mindset, where he was talking about the shadow inventory, about how home builders are building homes, but then keeping them off of MLS so that they don't flood the market with inventory, something similar that was happening with used cars last year as people repossessed used cars but didn't sell them right away. Well, that didn't work. The price of new vehicles is in free fall right now, and I suspect at some point soon we will see the same thing with home prices. Thank you very much, Nashville Pasta Man, sir. Appreciate the super chat, the support of the channel. And thank you to Barely Bearish. I like that name. I am not barely bearish. I am full-blown bear. I wear it on my sleeve, and I don't hide from it. He says, it's now common to see members of another community that I am a part of discussing the news you present. Oh, no. Am I going mainstream? Gross. Either you are covering the right stories or your reach is growing. I'd like to think both. Thank you, Barely Bearish. Those are very kind words, and that is encouraging to see. Geez, it's hard to stay contrarian if people start to agree with you. I might just have to become contrarian for contrarian's sake then. I don't know. Appreciate the kind words. Just curious, maybe drop it in the comments below. What is the other communities, the other groups? I'm curious to see where this news is reaching, where it's filtering down to. A lot of times you can tell what's going on with economic trends just by the person who is talking about it. Right? I mean, if a hairdresser is talking about home prices falling, or if a cab driver is talking about what's going on in the real estate market in China, that means that the news has reached a certain saturation point and that the story is now everywhere. It's probably a story that's close to peaking, depending on, who the person is, what circle that person is, and how far is that circle from the source of the news. So thank you very much, Barely Bearish. I appreciate the super chat, the support of the channel, and thank you, everybody, for spending your morning with us here at the Morning Update Live. Don't forget that like button and subscribe if you're new here. Thank you to my Patreon supporters for everything you guys do for the channel. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Until next time, live small and dream big.